today we're going to look at our tax system and specifically the difference between progressive and regressive taxes, as well as how those progressive tax brackets work. All right, so let's go ahead and get started here. Okay, so as I said, we're going to look at tax brackets. Okay, there's really kind of three categories that taxes can fall into. All right. By the way, I'm going to go through this. I know sometimes I kind of pass it off to you. I'm going to go through this myself. So if you haven't already, make sure that you download the outline here to complete while we're going through this. All right. I should have told you that at the beginning. But okay. So there's basically three kind of categories that taxes fall into, though two of them are very similar. So progressive is one, and then regressive and proportional essentially are the same thing with a different name. We'll talk about that. All right. So we've talked about progressive taxes a bit last week. Okay. Progressive taxes are what we use for the federal income tax. It's what most states use for their state income tax. Okay. Progressive tax imposes a greater percentage of taxation on those who earn a high level of income. All right. So the idea here is that those that earn a very high level of earnings, okay, can better afford to pay back into our social system. All right, and so they're asked to pay a higher percent into taxes. Okay, so like I said, the federal income tax is one. 33 states currently use a progressive system for their state income tax, though, as I mentioned last week, Iowa passed a law just a couple months ago that will transition from a progressive tax to a flat tax. So Iowa, when it converts to a flat tax in 2026, is actually going to take us down to 32 states. All right. So the opposite of a progressive tax is a regressive tax. A regressive tax is harder for low income earners. Okay. So this puts the same percentage of tax on everybody, regardless of their income level. All right. And so, as I said, it's disproportionately difficult on low income earners. Okay. So like a sales tax, all right, property tax, these would be examples of regressive taxes. Now, one type of regressive tax is a proportional tax. This is called a flat tax. Okay, with this, it assesses the same amount on everybody, so it's a regressive tax, but now we're looking as it applies directly to our income. All right, so an income tax that's flat. Okay, the idea here is that it creates equity amongst everybody. So the progressive tax creates fairness based on ability to pay. Proportional tax is based on equality in that everybody pays the same percent. All right. So currently there are 8 states that have a proportional flat tax. Okay. Iowa will become the 9th state. Now, if you're doing math in your head really quick, you might have done 33 plus 8 is only 41. They might be saying, well, that's only 41 states that have either a progressive tax or a regressive proportional tax, but there are 50 states, right? What are the other 9 states? So 7 of those states don't have a state income tax at all. Okay, that brings us up to 48. There are 2 other states that have no income tax, but they don't tax personal income from a salary or wages, but do tax income from capital gains, so selling investments at a profit. Okay, they do tax those investment profits as income. So they only tax some of the forms of income and not all. All right, so that is how our state systems are broken up. So let's talk about these 2 types, progressive and regressive taxes. All right. So the first one, progressive tax, as I said, it progresses or advances the amount that we pay based on a taxpayer's ability to pay. All right. So those with lower incomes have a lower tax percent than those higher earners. All right. Those that have a higher earning are asked to pay a higher percent because they can more greatly afford to pay that tax. All right, and the way that we do this is we create what are called tax brackets, grouping taxpayers into different ranges, and then based on where they fall, okay, they will pay different amounts or different percentages. Okay, so with a flat tax, the percentage that's taxed would be disproportionate for those low income earners. Okay, so if we didn't have a progressive tax, if we had a flat tax, like 8 states currently have for their state income tax, like Iowa is going to in 2026, okay, that becomes much more difficult for low income earners. Okay, even though the dollar amount that they have to pay in taxes is lower because they have lower income, Okay, its effect on their actual budget, on their actual spending power, is more pronounced. All right, and so it's harder for them to budget in or afford that tax. All right, so instead, okay, moving to a progressive tax, a progressive system, okay, asks them to pay taxes based on their ability to pay. Okay, and so low earners are asked to pay a lower percent so that more of their income can go toward covering their basic needs, their basic necessities. Okay, those essential items, things like clothing and rent and utilities, right? All of those things that we need to survive. All right, so even though we have a progressive tax system for our federal income tax, okay, it's actually growing flatter. It's still progressive, but it's more proportional than it has been in the past. All right, currently there are 7 tax brackets ranging anywhere from 10% to 37%. Okay, 40 years ago, or roughly 40 years ago, we had 16 brackets. Okay, so if you have more brackets, right, there are more essentially steps, there are more progressive steps. Okay, by eliminating those and combining brackets, okay, it has the effect of flattening it out. So it creates more of a proportional tax. So it's still progressive, but not as much as it had been previously. All right, advantages for progressive tax. Number one, again, I've said this multiple times already, reduces the tax burden on those who can least afford to pay. Okay, so it leaves money in their pockets, in their checking accounts to pay for those essential items that they have to have. Okay, outside of that though, another advantage is it tends to bring in more tax revenue to the government. All right, so the government relies on collecting taxes to pay for the services that it provides. So things like road maintenance or road construction, fire departments, police departments, public education, right? Parks, public works, public departments. Okay, at the national level, the government itself, the defense, right? All of these services are paid for by tax revenue. And so a progressive tax not only creates a more fair system, but it also generates more revenue to cover those so that the government doesn't run as much of a deficit. All right. And again, because the idea is that those who have a higher earning reach their success through a lot of hard work, no doubt, but they also utilize public support and systems like tax breaks if they own their own business, like utilizing roads just to get to and from their job or to facilitate distribution of their products or whatever, right? Everybody's success is reliant, at least in some part, on society's structure. And so those who are very successful, that have high levels of earnings, are asked to pay more back into those systems. Okay, so as I said, the opposite of a progressive tax is a regressive tax. All right, it takes a bigger chunk of a disposable income from low income earners than high income earners. All right, so it's more detrimental to people who really need that money. Okay, so sales tax is an example of this. If we go to the store and we buy the same product, okay, we're gonna pay the same amount in tax. Doesn't matter if you're a high school student earning, $8 an hour in a part-time job, or you're the principal of the building earning, 6-figure salary. Okay, everybody's going to pay the same tax on that product. Okay, so let's take a look as an example to kind of see how this actually works. We'll have low-wage Luke and high-salary Henry. All right, low-wage Luke earns $700 a week, whereas Henry earns $2,400 a week. Okay, now imagine they go to the grocery store and they buy the exact same bag of groceries. They spend $100 on groceries. All right, when they do that, let's say the sales tax is 7%. Okay, each is going to pay the same amount in sales tax. In this case, $7, right? 7% of a $100 bag of groceries, $7. For Luke, though, that $7 represents a greater percentage of his income than it does Henry. For Luke, that $7 is 1% of his income this week, whereas Henry, it's only 0.29%. Right, so only a third, less than a third of the impact on Henry as it has on Luke. So even though they're paying the same amount, that $7 is harder for Luke to actually afford than it is for Henry. So somebody who earns very little has a harder time paying a flat tax, a proportional tax, than somebody who has a high income. Okay, because the effect on them is a greater chunk of their disposable income. All right, when we take that and apply it to income, okay, we get a proportional tax. Okay, this works the same way. It applies the same percentage tax on everyone, regardless of their income. So whether you're low income, high income, somewhere in between, you're paying the same percent. Okay. And so because of that, it acts as a regressive tax. Okay. Because it's harder on those lower income earners. Okay. It places a higher financial burden on those. All right. Now, in the US, we actually have both a regressive and progressive system when it comes to collecting taxes. Okay. We've talked about our income taxes, right? That's a progressive system. The more you earn, the higher you pay in a percent of your income. Okay. So it groups earners into tax brackets based on their level of earnings. Okay. And each bracket carries a higher marginal tax rate. We'll talk about what that means here in just a moment. Okay. But we also have a payroll tax that's a regressive tax. The payroll tax is still based on your income, but it's a flat tax used for Social Security and Medicare. Okay. Social Security tax, Medicare tax also goes toward covering unemployment costs. Okay. These taxes are known as FICA taxes, stands for the Federal Insurance Contribution Act. That was the law that created the funds. Okay. That created those deductions. Okay, and so the reason it's called a payroll tax is because both the employee pays into it and the employer pays into it. Okay, so if you remember from last week, 6.2% comes out of your paycheck to go towards Social Security, up to a maximum salary of $137,700. Then beyond that, okay, those dollars aren't taxed for Social Security benefits. All right, and then for Medicare, 1.45% goes toward covering Medicare. Medicare doesn't have a salary limit, though it does jump at $200,000 or at $250,000 if you're married and file your taxes together. Then it jumps up to another 0.9%. So it's a flat tax up to one specific point, progresses, and then flat again. All right. So for the most part, both of these are regressive taxes or proportional taxes, in that they're a flat tax. Okay. So somebody who's earning, $30,000 a year versus $130,000 a year, they're paying the same amount or the same percentage into Social Security and into Medicare. Okay. One interesting side note, you'll notice that the tax is contributed by both employer and employee. So for me, I work for Linmar. Okay, so when I pay Social Security out of my paycheck every month, right, 6.2% goes into that, but Linmar matches that 6.2%. Okay, I pay 1.45% into Medicare. Linmar matches that. So if I were to find another job, let's say I started my own job, I started my own business, and so then I acted as both the employer and the employee. Okay, I would actually double the amount that I have to pay in, because I would have to pay both parts of that. I'd pay 6.2% as the employer and 6.2% as the employee. I'd end up paying 12.4% into Social Security, and I end up paying 2.9% into Medicare. So just kind of an interesting side note. All right. Anyway, so we've mentioned multiple times we have a progressive federal income tax system. Okay, Iowa right now is a progressive as well. So how do these tax brackets work? All right. Well, these marginal tax rates is the tax that you pay on each additional dollar. All right. So the word marginal means additional. Okay, so anytime that you hear margin, we're talking addition. So we watch Shark Tank, right? And the sharks are asking questions about the cost of goods that they sell versus their selling price, right? And somebody says, well, I sell it at $8 and it costs us $2 to make. Okay, and the sharks are probably like, oh, I love those margins, right? What they're talking about is the additional money there, the additional dollars from what it costs to make to what they sell it at. Okay, so when they talk about margin, they're talking about that additional. All right, you can think about a piece of paper, right? You got the white space around the edge. We call it the margin because that's extra or additional space that we generally don't use. Okay, that's where the name comes from. So when we're talking about margin, we're talking about additional. So these tax brackets are the rates at which an additional dollar is taxed. All right, so I mentioned earlier we have 7 different brackets. Right? The lowest is 10%, the highest is 37%. If I have a really high income and I'm in that 37th bracket, that only means that the marginal dollar is taxed at 37%. Some of my money still falls into that 10% bracket, and some of my money still falls in the 12% bracket. All right, and so on. So I've got a little video here that kind of summarizes this pretty nicely.
These are tax brackets for 2019. Simple, right? But many of us make a common mistake when looking at this. Let's say my income is $84,000. You might think that puts me in the 3rd bracket, so I would owe the federal government 22% of my income. This is wrong, and it's causing us to have uninformed debates about tax policy. here's how it actually works. Let's go back to my $84,000 income. Now, instead of thinking of tax rates as brackets, we should think of them as pockets. But first, there's one special pocket we need to talk about. The money we put in this pocket is not taxed. The government automatically lets single people put $12,000 in this special pocket, and more for couples. But if you spend a lot of money on things like medical expenses or charitable donations, you can sometimes put in more. These are called deductions. With the $70,000 that's left over, you can start filling up the pockets. The first pocket only has room for $9,700, so I only pay 10% on this money. Then I pay 12% on the money in the next pocket. And then 22% on the money in this pocket. These are called marginal tax rates, and that's how these brackets actually work. So if I get a raise, that new money goes into the first pocket with empty space. When space runs out, we put it in the next pocket. So the raise, and only the raise, would be partially taxed at 22% and partially at 24%. So when politicians say they want to raise the top tax rate, doesn't necessarily mean these pockets and your money are affected. They're talking about tax rates on the pockets way over there, which are only used once people have filled in these smaller ones. Marginal tax rates are a pretty simple concept once you get the hang of it. So the next time a politician says the government wants to take away 70% of your income, just send them this video.
As our income goes up, right, the range at which it falls into is going to go into a higher and higher percent. So, for example, let's say that I earned $250,000. All right, that $250,000 would fall into this 35% range. Okay, so most people, without knowing much about how these work, would say, well, then I'm paying 35% of my income in tax. But that's not how it works. Okay, all that means is the actual dollars that you earned in this range are taxed at 35%. The first 98.75 is taxed at 10%. Doesn't matter how many dollars I ultimately earn, right? I could ultimately earn $6 million this year. Those first $98.75 that I earned during the year will be taxed only at 10%. Okay, the next roughly $30,000, $30,200 more or less, is taxed at 12%. Again, it doesn't matter how much I ultimately earn. It doesn't matter how many dollars later on I earn. Okay, some of my money is still being taxed only at 12%. Then the next 45,000 is taxed at 22%. Okay, so some of my money, let's say that I ended up at $250,000. Okay, not all of my money is taxed at 35%. Only the dollars that fell in this range. So some of my earnings were taxed at 10%, some at 12, some at 22, some at 24, and some at 32, and then yes, some at 35. All right, but it's going to be much, much less than all $250,000. It would be like $42,000, $43,000 only that fell into that bracket. All right, and then if I got a pay raise, right, I would, or let's say right now a new teacher starts out, they're earning $40,000 a year, right? $40,000 a year, they're just almost maxing out this 12%. Okay, next year they get a couple thousand extra, it bumps them up into the 22% range. That 22% is only going to apply to the dollars that are above that amount, right? They go into that. The first 9,800, 9,900 are going to be taxed at 10%, the next 30,000 at 12%. So only the little bit of raise that puts her above 22% is going to be taxed at that 22%. Okay, so it works out to that the actual tax rate that you pay is going to be much, much less than this bracket, right? If I were that $250,000 earner, okay, my tax rate is probably going to be like 24 or 25%, not 35%, right? Because some of my dollars were taxed at such lower amounts. There's also a standard deduction. So if you remember back when we were doing our sample paycheck deductions, right? We could choose to put some money into a retirement account, choose to put money toward purchasing health insurance and so on, right? We could deduct those. Those were tax deductible. Well, the government says that everybody has, certain transactions and spending that's deductible. So you get to deduct this amount right away before calculating what bracket you're into. All right. So somebody who earned, let's say, 45,000 would be in the 22% range, right? That bracket. But they would get to deduct this amount before actually calculating their deduction. So if they were at 45,000, they could deduct this 12,000, and that would put them at what, 33, right? Roughly 33,000, which means they never would have gotten up into the 22% bracket. They would have maxed out in the 12% bracket. So that's another way you actually have then, first really big chunk of your earnings that aren't taxed at all. All right. So the biggest mistake is that people look at and they say, well, whatever bracket I fall into, that's how much I'm paying in taxes. That's not true. These are marginal brackets. So that only applies to each additional dollar, not all the dollars previous. All right, so we're going to do a couple of examples of this. Okay, so as your income increases, what is taxed is taxed at higher rates, but only the additional dollars are taxed at that higher rate. Okay, so the first dollar that you earn is taxed at in the lowest bracket, regardless of how many additional marginal dollars you earn. Okay, the last dollar is going to be the highest percent that you're taxed based on what bracket you fall into. And then all of the dollars in between are going to have a range that they're taxed at depending on what bracket they fall into. Okay, so here again is that tax bracket. Okay, so you can see that there are different rates. There are these different ranges. Okay, and then it also is impacted whether you're filing by yourself or married and filing together. Okay, so if we just focus on the single earner, and we look back at Henry and Luke. Okay, remember that Henry was earning $2,400 a week. Okay, so his yearly salary is going to be that 2,400 times 52 weeks in the year, which gets us to 124,800. Okay, so he earns 124,800 during the year. The first thing that we can do is subtract this deduction. So the government says some of your spending is tax deductible. We're going to allow you to take that out. So we deduct 12,400. So to get down to his taxable income, the number of dollars that are actually taxed. Okay. Now you don't have to take the standard deduction. There's also an option called itemizing your deduction. If you have a ton of medical costs, for example, right? Let's say that you're in the hospital for an extended period of time and you have a lot of medical costs, or you had a lot of charitable giving and that's deductible, right? You can do something called itemize your deduction if the value of those itemized entries would be more than this. Okay. Most people aren't able to itemize because if they itemize, it might be, $5,000, $6,000, $7,000. So they might as well take the greater 12,400. And that standard deduction increases a little bit every year. Okay, so we'll just assume right now his itemized deductions wouldn't be as much as that. So he's going to take that standard deduction. Okay, so we subtract that 12,400 from his salary, and we get a taxable income of 112,400. Right, 124,800 minus that 12,400, we're down to 112,400. So if we look at this tax table, okay, in these brackets, 112,000 gets us right in this range, the 24%. Okay, but again, that doesn't mean that he's actually paying 24% in taxes because he's already got 12,000 that wasn't taxed at all. All right, so we need to break his income up into the various different brackets. Okay, so the first 9875 is going to be taxed at 10%. Then the next roughly 30,000 is going to be taxed at 12%. Then the next roughly 45,000 at 22%, and then the next range, even though the range goes up to 163,300, we're going to stop with the last taxable dollar that he earned. So even though it goes all the way up to 163,299, right? Or 60,300, right? We're going to stop at 112,400 because that was his last taxable dollar. Now, one really important note is that these are not subtractions, they're ranges. So when I need to calculate how much money is in this range, okay, I can't simply subtract those two numbers together. Let me pull up the calculator and show you. Okay, so if I went 40,125 minus 9876, okay, that's $30,249. But that's actually incorrect. Okay, what I need to do is I need to take the maximum dollar here and subtract out the maximum of the previous range. So 40,125 minus 98.75. Because I need to include that $9,876 being taxed at 12%. Okay, so essentially what I'm doing is subtracting out the dollars that have already been taxed. The first 98.75 was already taxed at 10%. So that's the dollar amount that I need to subtract. If I were trying to calculate this range, okay, the 22% range, 85,525 minus the dollars that have already been taxed. So some at 10%, some at 12%. So the previous amount that has been taxed total is 40,125. Okay, so I can't go by the starting number here. I need to subtract the ending previous number. Okay, otherwise your ranges will be off, your calculations will be off. In real life, okay, that means you could mess up how much you pay in federal taxes, which you don't want to do because then the IRS is likely to audit you, and that is a very time-consuming and can be expensive ordeal. So make sure that you're getting this right. All right. So you calculate how many dollars are in each range, and then multiply by that percent. Okay, so $987.50 would be would be the 10% of that range. 12% of this range is $36.30. 22% of this range $99.88. 24% of that range $64.50. Okay, so overall, if we add those up, we get a total of $21,055.50. But we round tax dollars to the nearest full dollar. So 50 cents, we would actually have to round up to $21,056. Okay, so he owes $21,056 in federal income tax. We can take that number and figure out his effective tax rate. Sometimes it's called an average tax rate. Okay, this is the percent of his income that he actually has to pay in federal income taxes. All right, so as a reminder, his gross income was $124,800, right? We brought that down by his standard deduction to get his taxable income, but we want to know how much of his total income was taxed. Okay, what percent that was. So we're going to use his total gross income, $124,800. And so all we're going to do is divide the amount that he owes in taxes by his total gross income. So $21,056 divided by $124,800 is 16.87%. So this is the percent that he actually paid in federal income tax. So even though his bracket, he fell into a 24% marginal bracket, okay, he did not pay 24% of his income in taxes. He paid less than 17% in tax because some of his dollars were taxed at 0%, some of his dollars were taxed at 10%, some at 12%, and so on. That pushes down his overall average. Okay, so the effective rate that you pay is always going to be less than the marginal rate. His marginal rate was what his last additional dollar was taxed at. That's what bracket he fell into, the 24%, but he didn't actually pay 24% in taxes. He paid under 17. Okay, now going back to Luke as just another example. Okay, remember that he earned $700 a week, multiply that by 52 is a yearly salary of $36,400. Okay, standard deduction is still the same, $12,400, so we subtract that out. Okay, his taxable income then is $24,000. All right, $24,000 gets us into the 12% range. So we're only going to have two percentages to calculate, right? The first range is the same. And the second range, because he didn't max out, the second range could potentially go up to 40,125. He didn't max it out. So we're going to stop at 24,000. Okay. 10% of this range, just like it was for Henry, is the same amount, $987.50. 12% of this range is $1,695. Okay. No money went into the 22% bracket, none into the 24, into the 32, and so on. Okay. He just has those two brackets. We add those up. Okay, and we get $2682.50, but we round to full dollars, so $2683. All right, so then what is his actual effective rate? How much did he actually pay in taxes? We're going to take the amount that he owes, $2683, divided by his income, and we get 7.3%. So again, even though he fell into the 12% bracket, paid just over 7% in taxes. So that's as I've said, this is the most common misconception about how these brackets work, is that just because your income falls into this range does not mean that you're going to pay that amount in tax. It just means that the last dollar in that range is going to be taxed at that rate. All right. Now that we've completed that presentation, I've got one additional video I want to show you, and it does a really nice job of talking about how to calculate those taxes. Okay, so the video, we've talked a little bit, just briefly about how to do this. This goes into a nice kind of visual representation of how to calculate those taxes.
Omira made $45,000 in 2019 at her full-time job. How much does she owe in federal taxes? Many people might look at the 2019 tax brackets and think that because she makes $45,000, she must fall in this bracket. So she would owe 22% of her income to taxes. So does that mean that she owes almost $10,000 in taxes? We can debunk this common misconception by learning how to calculate your tax due. The first step we need to take is to determine Omira's taxable income, or the amount of income that is used to calculate her tax due. Here's how. We first start with gross income, which is how much money you made in the calendar year. Then we can subtract the standard deduction, which is the portion of your income that is not subject to tax. This equals your taxable income, and we can use this number to calculate your income tax due. So in the example of Omira, her gross income is $45,000. Then we can subtract the standard deduction, which in 2019 is $12,200. Be sure to check the updated standard deduction each year. $45,000 minus $12,200 is equal to $32,800. We will use her taxable income value to then calculate her tax due. Now that we have her taxable income, the second step is to identify which tax bracket her taxable income falls in and the percentages for each relevant tax bracket. Going back to our 2019 tax brackets, we see that our taxable income of $32,800 falls within this bracket. We will need this bracket and any previous brackets to calculate her tax due, so I'll box these two brackets. Let's go to the drawing board, and now we can calculate the tax for each bracket. I'm going to draw a long box to represent Omira's taxable income, starting at 0 and going up to her $32,800. According to the tax bracket table, the first bracket goes from 0 to $9,700, so I'll indicate that here. Still using that tax bracket table, I see that the first bracket is taxed at 10%, so I'll put that in the first box. I also see that the next bracket is taxed at 12%, so I'll put that in the second box. Now that I have my visual, I can set up an expression to start calculating. 10% of this first bracket will be 0.10 as a decimal, times the difference here, so 9,700 minus 0 is just 9,700. Then for the next bracket, 12% as a decimal is 0.12, times the difference here, so 32,800 minus 9,700 is $23,100. Now it's time to calculate. 0.10 times 9,700 is 970, and 0.12 times 23,100 is 2,772. The last step is to add the taxes for each bracket together, and we get $3,742. This final answer is Omira's total tax due. We have taken 10% of the first bracket and 12% of the second bracket and added it together. All right, let's review. First, we determined Omira's taxable income by taking her gross income minus the standard deduction. Then, we identified the percentage for each relevant tax bracket, in Omira's case, 10% and 12%. Next, we calculated the tax for each bracket by multiplying the percents by the difference in each bracket. And our final step was to add the tax for each bracket to find Omira's total tax due.
All right, now that we've completed that presentation, you've got one worksheet that will practice your understanding of these tax brackets. It is this 2.2 tax bracket practice worksheet. Okay, so I'll show you what this looks like. On page 1, all right, we've got a sample tax bracket here. So we've got the marginal tax rates, we've got the range of dollars that apply for those various percentages, and then we have our standard deduction listed at the bottom. So we have 3 scenarios here, 3 individuals that are each filing taxes on their own. All right, on page 2, we have an example of a married couple filing together. All right, and so we have the same percentages listed here, but we have different ranges. So make sure that you're paying attention to that. As we have 2 people filing together, the ranges change, as does the deduction. All right, the standard deduction doubles to account for 2 individuals. The rest of page 2 just has some questions, just kind of gauging your understanding and comprehension of how tax systems and tax brackets work. And then the last page, again, just general questions, as well as another sample tax bracket with different percentages, different ranges, and just some questions that pertains to that. All right. So this is the only worksheet that you need to get done. Have it completed before we meet again. We'll go over this at that time, and then we'll have some more tax practice. Okay. Enjoy the day, everybody. We'll talk soon.